Hi, this is Jason, Chief Technical Analyst with Toro Alerts with your weekly market update. Another volatile week in the market, so let's jump right into the charts and see what we're taking a look at. Started off the week almost at the 200-day moving average, but then had a bit of a drop-off on Tuesday and then kind of chopped around for the rest of the week. Some fairly decent moves in the S&P 500, but really down, up, down kind of end towards the week. And so right now the bias is looking like it's probably to the downside, but this market's been so volatile that we could see a reversal to the upside as early as next week, so we'll just want to keep an eye on that. One of the key volume support levels I'm looking at is about 434 on the SPY. If we see it bounce off of that and move to the upside, that might be a signal that the markets are heading back up from there, but we're going to watch that closely going into next week. Taking a look at the NASDAQ, we talked last week about how it broke down below a key Fibonacci level at about 354, so we were looking for it to potentially sell off, and that's what it did. Now we're also below another key support resistance line at about 341.50, and it did fall below that, so right now the NASDAQ also is looking like there's potentially more downside currently until we can get back up above the 354 level. Not really looking for too many trade opportunities in the NASDAQ at the moment. When we jump over to the Dow Jones Industrial Averages, we've been a lot less volatility there. So industrials are looking like a lot less volatile and safer space to be right now, but still a lot of sideways chop and not a lot of clear direction as well. On the Dow Jones Industrial Average, we do have a pretty strong volume support level right around the 344.50 level, which it did pull down to at the end of the week and kind of hold the support there. So we'll want to see if that does actually act as support and moves to the upside going into next week, or if it breaks down below that level. That'll really probably give me the bias as to what I'd be expecting going into the Dow Jones Industrial Average for next week, is that 344.25 level. Taking a look at transports, last week we talked about how it had held as support on this key Fibonacci extension level at the 14,369.370 level, and it did hold as support this week. Taking a look at the weekly candlesticks here, we did have a nice move to the upside in the transports. So as long as the transports are holding above that 14,370 level, I think that's a decent enough signal that probably a broader market sell-off's not likely at the moment, and there may be some short-term trade opportunities in the transport space as long as we're holding above that 14,370 level. When we jump over to the relative rotation graph and start taking a look at some of the industry sectors, we can see some of the ones that have really outperformed over the last 2 weeks. The absolute winner this last couple weeks has been the natural gas fund. We're up almost 30% in 2 weeks on natural gas, and so that's been a great trade opportunity, trading natural gas stocks or the actual natural gas itself. And then we've also seen some strong price action out of the metals and mining sector, about 7.5% in the last 2 weeks. Gold miners specifically, about 6.5% in the last couple of weeks. So we're starting to see some bids pop up in the gold and silver space after those had cooled off for a while. Also seeing energy start to rebound again. We saw a fairly slow month in the month of March in energy, but we started to see that turn around in April, and I think we are just getting started to head quite a bit higher in the energy sector. So I think a lot of energy trades are some excellent opportunities right now to look for some stocks in that sector and put some positions on. We also saw silver have a nice move, so it's not just gold participating. We also saw a nice move out of the silver space, and then steel is also the other space that had a fairly decent week with about 3% returns. But as we can see, a lot of sectors in the red. Some of them are down double digits, 10, 11, 12%. So there's still a lot of sectors that are really getting beat up right now, and so it's really important if you're going to be trading these markets to be identifying on what the stronger sectors are, and to set up a lot higher probability trades if you're in the right sectors and pick good stocks within those sectors. Jump over to the Russell 3000. We've been talking about this 50-week moving average for quite some time. We did get above it a few weeks ago, but then broke back down below, and the bias was to the downside this last week as well. So for the broader markets, until we can get back above that 50-week moving average, it's looking like a bit bearish at the moment. And then when we jump over to the small caps, the Russell 2000, we've seen a lot of chop over the last couple months. We did come up against a key resistance level at the 209 level. Almost got above it, but never were able to close above it, and then sold off quite a bit 2 weeks ago. This week we did have a bit of a move back up to the upside, but it didn't go very far. And So we'll probably be looking for that to move a little bit lower going into next week, and really until we can get above either the 204.50 or the 209 level on small caps. Definitely have my bias be towards the downside on small caps at the moment. When we're looking at the large caps, we are at below the 50-week moving average on that one as well, and so large caps also are looking like they're under pressure. When we jump over the value line geometric index, about 1,700 stocks in the New York Stock Exchange represented on this graph. We are below a key support level at about 630.70, and we dropped below it last week, pushed up to it this week, but then it acted as resistance, and then it pulled back off of that. So right now, for the broader markets, that's also looking fairly bearish. When we jump over to the Vanguard All World ex-US, so this is the stock markets across the globe minus the US, we've seen 2 weeks to the downside on that chart, and would expect probably some further downside movement in the emerging markets and the rest of the markets outside of the United States. And when we look at on a relative terms, emerging markets divided by the S&P 500, it's been fairly sideways chop. So while we've seen the rest of the world kind of have some downside pressure, obviously the U.S. has had a bit of downside pressure as well. So really, on relative terms, neither the U.S. or international stocks are having any major bias. They're both kind of underperforming at the moment. And when we take a look at growth versus value, we've talked about this quite a bit since November of last year. Definitely the trend has been towards value over growth. We did see a 2 or 3 week period where growth really had a nice move to the upside and maybe looked like it was reversing, but then we had a big sell-off 2 weeks ago, and then this week continued to the downside. So it's looking like value is definitely a strong outperformer over growth currently. Then we jump over to the WTI Crude. Interesting things here. We've been watching this Fibonacci speed resistance level really closely. It has really acted as nice support all the way back into August of last year. We did have a breakdown below it once, but each time we got above it, it really has been a nice strong support line. And we've had multiple weeks where it's really held that level nicely. And so we also have a nice trend line channel that it hit as resistance this week. So as of right now, I'm going to be watching both the trendline channel as well as the speed resistance channel really closely to see what the next direction is on oil. I still think long-term the bias is to the upside. Would shock me to see us at least get up to the 147.50 level, which was our previous all-time highs. But for now, I really want to see us get above this trendline channel before I get super bullish on oil again. And we'll be watching that one closely over the coming weeks. When we jump over to the commodity CRB Index, commodities had a big week again this week, big move to the upside, but we are up against some key support, key resistance at the 313.70 level right now. And so if you're not in some commodity trades right now, probably not the best time to go into a commodities trade at the moment, because that could end up acting as resistance, and we could see a short-term rollover from here. But if we see this pop up above the 313.70 level and move to the upside from there, the next level we're targeting on the CRB Commodity Index is 366. So if and when we likely get above that level, then I think there's still going to be some great commodity trades going forward. But as of right now, probably wouldn't want to be looking to get into any tactical trades right at this moment until we see it break above that 313.70 level. Jumping over the high yield corporate bond ETF, we did drop down a bit this week, but we did hold a key support level at the 79.50 level. If we do break below that level, there could be a nice short opportunity with a price target to the downside of about 75 on the HYG. But as long as we're holding support at the 79.53 level, the bias on that's probably more to either sideways action or possibly even a move back up to maybe the 82.50 level. And then we look at the corporate bonds on relative terms divided by the traditional treasury bonds. This gives us a nice indication to the overall health of the market. And as long as we're above the 0.66 level on this chart, then I'm not too worried about a major sell-off. I'd want to probably see a breakdown below the 0.66 level, as well as a spike in the VIX as more of a signal for a possible deeper correction. So as long as we're holding above that level, then not looking like we're expecting any major aggressive sell-offs at this point. And then we jump over to RCD divided by RHS, so this is consumer staples relative to consumer to defensive sectors. We did hit a key level here at 0.74, which acted as support. So we'll want to watch that going into next week and see if that ends up holding a support. And maybe we'll actually see a bit of a move to the upside, which would be a bit of a risk-on signal. But if we do break down further below the 0.74 level, then that would show us that people are getting even more defensive and picking up more defensive sectors like healthcare, utilities, and consumer staples. Taking a look at the US dollar, we did get up to the 150 level, which we were looking for the next key target to the upside for the US dollar. Still think the bias on this is to the upside. The next key price target level we're looking at in the dollar index is the 103.85 level, and that would probably be the next level I'd be looking for some possible resistance at that price level. Saw some nice moves out of gold and silver this week. Taking a look at the gold chart, we did get a bit of a move to the upside, but I'm really looking for a break above the 186 level on the GLD before I probably look to enter any trades on gold at the moment. And then jumping over to the silver chart, same thing, another nice move in silver this week, but I'm really looking for a break above probably 24.25 for a signal to get back into the silver trade. And then jumping over to the VIX, we saw the VIX hold support around the 200-day moving average this week. Started out on Monday and then had a big spike up to about 25, then a big drawdown almost to the 200, actually exactly to the 200-day moving average again, and then moved to the upside and finishing Friday at about 22. So some choppy action on the VIX this week, but didn't get above the 25 level, and it also didn't really break down below the 20 level, so it looks like still some sideways action in the VIX between the 20-25 spot. And jumping over to the Treasury bonds, we saw for the first time in quite some time, we actually saw the Treasury bonds in the 2-year sell off a bit this week. It looked like it had a bit of a top at around 2.6, ended up closing the week at about 2.45, but it got as low as 2.281, and so we'll be watching that one closely as a possible rollover in rates on the 2-year if we continue to see a move to the downside going into next week. And there's an interesting chart we've been watching on the 10-year yield. This is a log chart, about 40 years of history here. This is going back all the way into 1980. And on this key trend line that we drew here, we can see that we've held that as resistance multiple times. We had 1, 2, 3, 4, 5 different times where it's held as resistance, and this 5th time is basically right now. So this weekly candlestick literally hit that trend line resistance. So we're going to watch that one really closely. We've had a massive move in rates, fairly quick rate of change in rates have been very aggressive, and so there could be a really nice trade opportunity developing in bonds. I'm not typically a bond trader. I typically just look at the bond markets for more market signals and overall indications of market health. But I think because we've had such an aggressive move in rates and an aggressive move to the downside in bonds, that there might actually be a really nice trade developing in the bond market right now. And I'm looking to set up a trade for that. What I want to look for this going into next week, though, is I want to see that it holds this level as resistance. So we're right up against this trend line right now. So if we see a rollover going into next week where it moves to the downside, then that could be a really strong signal that there could be some nice bond trading opportunities. So I'll be looking at both the IEF and the TLT for some possible call options if we see a rollover in the 10-year. We're already seeing a rollover in the 2-year. If we see that develop in the 10-year as well, especially with this 40-year trend line on our log chart here, I think that'd be a strong signal for a possible short-term bond trading opportunity in those sectors. Jumping over to the 30-year, we had a big move in the 30-year the last couple weeks, and really for about the last month was when we finally broke above the 2.4 level, which is a key resistance level we're watching. We had a big move off of that, then a big retest back down to that level, and then the last 2 weeks it's just launched off of that, gone from 2.43 to 2.9 in 2 weeks, which is a very aggressive move for the 30-year bond. And so one of the key levels we'll probably be watching for on the 30-year is that 3.2, 3.25 level for a possible rollover if we see that in the 30-year. And then we've talked about the yield curve over the last couple of weeks, a lot of talk in the media about that as far as a possible signal for recession. But we had a big move up off the zero line on the yield curve. Didn't stay down there very long at all, and we had a very, very strong move up all the way to 0.37 from under zero in the last 2 weeks. And so that was a big bounce off of the below the zero line, and so we'll be watching that one going forward. but it's looking like we're significantly above the zero line on the yield curve at the moment. Make sure to download the Toro Alerts app on the App Store. We'll get you set up with the promo code for 1 free month for trading stocks and options. And also make sure you check out our new crypto app, Toro Alerts Crypto. Download them both on the App Store, and we'll see you next time. Thanks for tuning in.